From the morning reading, the SPX continues consolidation as Netflix and several of the railroads have earnings in gap higher. CSX, NSC, and UNP, all amongst the railroad group. Breadth weakened compared to the prior session as decliners led 22.25 to 771 on the New York Stock Exchange and led 2017 to 774 on the NASDAQ. On the S&P 500 snapshot, a decline in advance of the inauguration. The S&P 500 hit its 0.11% intraday high 5 minutes into the session and then sold off steadily to its 2 p.m. plunge to its negative 0.59% intraday low. A weak buy the dip strategy trimmed the closing loss to negative 0.36%. The 500 has alternated between gains and losses for the past 6 sessions. Its elderly cousin, the Dow, has posted 5 consecutive losses and 8 declines over the past 10 sessions. A sell program hit stocks on Thursday. Just after noon, there was a large number of sell orders that hit the New York Stock Exchange, swamping the buy orders that traders had entered. The exchange hadn't seen that large a rush to sell in more than a month. Other times that stocks were hovering near the high, then saw a surprisingly large sell program. Stocks continued to see weakness over the shorter term. The Dow is negative year to date. The drop on Thursday marked the first time in 2017 that the venerable Dow Jones Industrial Average was negative for the year. Going back to 1900, there were a handful of times that the index last 2 to 3 weeks into the year before turning negative year to date, and it tended to lead to even more weakness as nervous traders sold. Options traders are showing some nerves. For the first time since November, options traders cleared the ICE exchange showed just as many protective put options bought as speculative call options. But options indicators tend to be contrary only when they are extreme over a 10 or 20-day period, which this isn't yet. Anytime there were as many or more puts bought as calls, the S&P actually declined over the next 2 days, 58 out of 108 times, for an average return of negative 0.4%. In other news, the 10-year Treasury yield is bouncing off its 50-day average. The dollar index also bounces off support. The gold market meets resistance. The Dow remains flat. Stock and the bond ratio still favors bonds. Uptrend in junk bonds is also stretched. Let's see if I want to go into any more detail on that. I think that's probably enough. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6 o'clock a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 20th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce into the morning report. And at the time of this cut, all 4 of the U.S. broad-based indices were up just above scratch. Crude oil is up about 1.2%. Euro is down about 0.25%. Long bonds down about 0.5%, and gold down just below scratch. In overseas action, it's mixed. China up about 0.7%, while Hong Kong is down about 0.7%. And to split the difference, Japan is up about 0.33%. Germany's at scratch, and the United Kingdom is down just below scratch. In terms of macroeconomic reports for today, you have FOMC member Harker speaking, and then, of course, you have the inauguration, and included in that will be President-elect Trump giving his inaugural address. So there could likely be some movement in the markets as he speaks to the priorities of the next administration. In terms of current volatility, the short-term VIX 11.50. The skew remains pretty significantly elevated, up over 140 at a 143.43. IV percentiles also somewhat higher than they've been in recent sessions. IV percentile for the S&P is a 16, the Russell a 20, the NASDAQ an 11, and the Dow is 17. But keep in mind, these are all still red. They're still all in the lower third of their annual range, so exceptionally low in the big picture of things. In terms of a close-to-close basis, standard deviation size moves were put in by the S&P and the Russell. The Russell's actually had 9, I believe, of the last 20 sessions with standard deviation size moves. While that one's been more volatile, I would suggest that that's actually about normal. And what's abnormal is actually the other indices are below normal. And you can see here the Dow's had no standard deviation size moves in 2 weeks, and the NASDAQ and S&P have only had 1 in the last 2 weeks each. In terms of, let's go to the charts. And one of the things to kind of keep in mind here is if you looked at the weekly candles, and you go back a couple weeks, you would have a situation where the weekly candle from 2 weeks ago is an inside candle in relationship to the candle of 1 week ago. So we've actually had compression with this week being smaller than the week prior. And actually, while most of this action is within a very small range, and you could draw a box on almost everything here from about December the 9th through the current session, this one little hiccup right here, technically, that's just a false breakout, and it was quickly nullified. So you could almost, from a technical standpoint, ignore that undercut as being of no value, and then just draw a nice clean box around all this. And that's where you are as we come into the inauguration period. Now, we'll likely start to see some increasing volatility as real policy, real actions start to take place, and more indications as to where those changes might be as we move into this new administration period. So very, very tight compression, very unusual, but it's all part of the process of what's going on across the nation. Now, the Dow has, we've talked about this in recent sessions, has had this kind of slight bearish bias, but we don't want to make too much of this because, while we've had several days in a row that have been negative, they're just so slightly negative. We've not even had a standard deviation size move, so there's just been this drift towards the bearish side, but nothing to kind of get terribly excited about as of yet. And indeed, going the opposite direction has been this drift to the bullish side on the NASDAQ. So tech-oriented has been actually going up, and that's usually your more growth-oriented stocks, at the same time that your dividend-oriented or more conservative stocks have been drifting down. So the question is this really bearishness in the market, or is it just rotation from more defensive areas into more tech and growth-oriented holdings? Now, the Russell, of course, has also seen a little bit of a negative drift. But again, you could easily draw a box around much of this action in recent weeks, and it's been a very subtle drift for most of that time. In other markets, crude oil, sideways as well. Gold has seemingly come up against resistance and is falling back. One of the morning authors mentioned that in the early reading there. And then also bonds also falling back from that similar area of resistance. All of this probably related to what the dollar's doing. The dollar seems to have found its footing and is starting to gather some strength. So we'll see if the dollar starts to move up, what these other markets start to do. And then finally, let's take a look at volatility. Volatility has been a bit elevated off its extremely low levels, but it's still even in the lower edge of the normal band of the 12 to 15 that you find in normal bull markets. So nothing here to say other than perhaps that the Russell might be, this might be a bit more significant in that it's starting to actually break. We had a standard deviation size move. It's actually starting to break down below this box. This is a closing low. So that might be the most significant sign of bearishness, but is it just the very, very beginning of the process, or is this just noise? And at this point, I think you could make cases for both sides. Don't get overly worked up about these early signs, and yet at the same time we'll continue to watch and pay attention to them, because that's what we do. We watch for change and we watch for rate of change, and we've seen some other indications of change as well. As we get into the daily report, the intermediate term phase opinion, we have gone to market phase 5, and that was a break of the diagonal support. It just barely broke, but it did break. And, in strong bull markets, you don't see a break of diagonal support. So that is a change. In terms of the 3 market timing signals, though, we haven't seen any changes there. The first signal coming to us from IBD, confirmed uptrend. That's bullish. GMI index, a 5 out of 6 still, with a buy signal in place since 11:10. That's bullish. And then stock charts decision point scoreboard still remains with mostly mixed signals on the short and long term, with a bullish signal universal across the intermediate term. So consensus across all of this is a slight bullish bias. And certainly that is important, but yet we have an awful lot of these mixed signals that give us some pause. Position sizing opinions both holding up at 100%. Intermediate term market posture has started to show some increasing change. And you see now not just the Russell in the weak bear, which had gone through a period of oscillating between weak bear and strong bull, has clearly broken into the weak bear. If this drops below a 50, this actually goes to a strong bear. It's now been joined by the Dow. But look at this, the Dow 79.9. This, in a football analogy, means that the Bears have the ball, but they're on their own 1 yard line. They got 99 yards to go to score. So this is as weak a bear as you can get from this indicator standpoint on the Dow. But yet you got to give it that the Bears have the ball. So much easier to score when you have the ball. And you see the S&P still holding up above this 80 threshold and still holding on to this exceptionally strong bull, as is the NASDAQ. But in the case of the S&P, this has been eroding ever so slightly. So you can see that we're starting to get a little bit of mixed signals. The most important signal coming from our benchmark S&P, and it's that exceptionally strong bull, and it's supported by an exceptionally strong bullish sentiment line. So the expectations are that any weakness are relatively short and not terribly strong in terms of their persistence and how far they might fall. But at the same time, we continue to see this kind of erosion in the scores. Overall hedge warning status still a 0+, normal with some elevated conditions. And strategy opinions, no changes from yesterday. It's all 3 opinions are given the okay to initiate new positions for the novice traders, and yet at the same time maintaining a fairly conservative structure with much of that activity. In terms of specific areas of warning, we continue to see this with volatility be perhaps the most active, but we're starting to see other areas as well. We did have that volatility ratio fire 2 sessions ago. We do have this distribution day count continues to kind of be problematic. With the NASDAQ at a 7, skews elevated, it's at a 143, so that's getting about as high as we ever see it. 145 plus is about the top of that skew. So there's definitely some outside activity going on in terms of the outer ranges of calls and puts being bought. In terms of the trend area, you did have that weak signal coming in market phase 5, the break of diagonal support. Nothing else here of real interest. In the intermarket risk aversion indicators, we've had this persistent risk off set of indications coming, and now all 5 of them have been there for a couple sessions. Sentiment, about as neutral as you can get, coming in at a 53. From a sector standpoint, we've talked about, how it seems like maybe some of this money is moving away from Dow dividend type stocks and moving into those tech. And yet, when you look at this has been something we've also talked about in recent sessions. Breadth is actually relatively poor in the tech sector, and it's just been a handful of companies that have been doing well. And you see tech was actually negative as a sector yesterday. In fact, if you look at what was green, only industrials with a relatively robust up 0.67%, followed by the 2 big telecom companies posting positive days. Other than that, it was probably fairly hard to find a significant company with a positive day. And certainly down here at the bottom, real estate, utilities, consumer staples, all coming in with negative days. So if it was a risk off day, perhaps, but it wasn't really a risk on day. I mean, other than AT&T and Verizon and a handful of industrials, and a handful, even lesser handful of tech, there just really wasn't much, going into anything, it would seem. And indeed, if you look at the market posture by sector and across the different time frames, you see on the short to intermediate term, there's quite a bit of weakness here, and there's really only a handful of sectors that are currently holding up as positive, bullish on all 3 time frames. Transportation, the 2 consumer sectors, industrials, and technology still holding up as positive. The weakest being healthcare, energy, and financials. And financials, of course, have been the hero in much of the last 90 days, but starting to really give up some of those gains. And in fact, down here, we can look at the 3-month, and you see that financials 3 months were up 18%. That is by far the best performance in the rolling 3 months, but that's starting to come down from where the highs were in the low 20s. And you see other sectors, especially on the 1-month standpoint, where we've gone into this sideways consolidation. Our best performance on that 1 month now is less than 2% with information technology. And you see energy down 3% in that same time frame. So a lot of negative here in the 1 day, 5 day, and now bleeding more and more consistently through the 1 month. As you see that kind of downward drift from this consolidation pattern starting to show itself with more consistency and across basically essentially all sectors. So this isn't a continuation of rotation at this point. This seems to be an erosion across virtually all sectors. Okay, I think that's probably enough for today. Let's go ahead and wrap this thing up. I'm going to roll through these slides right here. If you see something of interest, just hit the pause button. Tells you about our subscriptions and so forth. We've got 2 basic packages. One, especially for those active traders out there, gives you the daily price guides. This gives you all the technical support resistance levels for 8 key markets each day. And then also regular room membership, which gives you everything. Very modest, $50 a month. There is a free trial available. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom of the slide for the full set of disclosures. We'll be back here next Monday for the Falcon Global Market preview. In the meantime, manage that risk profile and seek to go out there and learn something about your craft each and every trading day. Good trading.